So continuing on from the live webinar we had on week 3, we're going to finish off this little example of looking at FIFO, LIFO and weighted average. So in class we had looked at the closing inventory value of FIFO, LIFO and weighted average. The other part of this then is to look at what is actually the results, the trading results for each of the methods for the first 6 months of the year. So we're going to look at a little table like this where we're going to compare FIFO, we're going to look at LIFO and we're going to look at weighted average. And we're just going to compare the three of them here and look at the revenue, the opening inventory, purchases, closing inventory, etc., and figure out what the ultimate gross profit is to show you that the different values of closing inventory can have a significant impact on gross profit. Now, the revenue and the purchases does not change for each method. It's 7,000 in all three scenarios because you still sold the same amount of units at the same price. And that was told in the question here. €7,000, 1420. Likewise, there's no opening inventory, so that's a nil in all three scenarios. And your total purchases for the 6 months, that's the same as well. So this will be nil, this will be 6510. So the only real difference here is the closing inventory and the impact that that has on gross profit. So today, they're all the exact same. This is what they're asking you, the impact on trading is to calculate the impact on gross profit. Closing inventory for FIFO, if we start with that one, if we go back up and look here, we said 3077.5. Now remember, that's going to be a negative figure because closing inventory reduces our cost of sales. For LIFO, 2310. And for weighted average, 2690. And based on that then, you can actually calculate and determine the cost of sales for each one, which is 3432.5. That's the cost of sales associated with the amount of goods that were sold. Right, you sold 1420, should I say. You sold it for 7, that cost you 34. In this case, 6510 minus 2310, 4,200. And in this case, 3820. So in all three instances, closing inventory has an impact on cost of sales. And what that then falls down to is you're now looking at, well, what impact does that have on gross profit? So we're looking at here, 7,000 minus 3432.5 gets you 3567.5. 7,000 minus 42 is 28. And 7,000 minus 3820 is 3180. So in all instances, you have different gross profit figures. The higher the closing inventory, the actual higher the profit. That's something to watch for. If you overstate your closing inventory, your assets, i.e. current assets, are going to be overstated, but so is your inventory. That's why it's very much a key item that you need to watch for manipulation, because there can be an incentive there to manipulate both financial statements. The lower the closing inventory, LIFO, the lower your profits. Because the lower your closing inventory, the higher your cost of sales, and therefore the lower your profit. So that's a key thing you need to be able to understand, is the difference between FIFO, LIFO, and weighted average. And remember that only FIFO and weighted average are allowed under IAS 2. LIFO is not allowed. So hopefully that gives you a good idea. The other key thing to watch for, and we mentioned it briefly in class, is that inventory should be measured at the lower of cost and NRV. So we know the issues around cost, how to bring in what costs are allowed, how to bring in overheads in terms of allocating them, and also how to deal with FIFO and weighted average, depending if you've that scenario with interchangeable goods at different prices. The other thing we need to consider is, well, what is NRV? NRV is the selling price for the inventory less the cost to have that been incurred to achieve the selling price. So for example, if you have to adapt the product or if you have to repackage it, all of that is allowed to be included in NRV, the cost of selling the particular good. So when inventory is damaged or obsolete or the market prices have deteriorated, you're going to have to do an NRV check to make sure none of your inventory is overstated in the financial accounts. Right? So it's written down on an item by item basis. You look at each item in your inventory and say, is that written down? Now, sometimes the item and item basis can be an exception where you can group them together if they're marketed in the same area and they're not evaluated separately. But generally, and from our exams perspective, you're looking at an item by item basis. And when the write down is material, so when it's significant to the financial statements, you show it separate. For most of our exam questions, you can put the write down through cost of sales or you can put it through admin expenses. But if it's a significantly big item, you can leave it as a separate line item under IAS 2. Right? So your definition then for NRV is what you can sell it for, the sales proceeds, less any trade discounts you have to give to the customer, less any cost of further cost of completion. So for example, you might have to repackage it, you might have to repair a good that got damaged, and any selling and distribution expenses. That might be transportation costs, it might be marketing costs, etc., that you include as well. So the net of all those figures gets you what we call our NRV, your net realizable value. So the easiest way to look at this then is let's look at a small example. Right? An item inventory cost 4,000 to produce, was damaged by a burst water pipe. It can now be sold for 4.5. So a lot of people say, well, sure, Holy, that means it's bigger, no issue. But repair work must be undertaken of 1,000. That's further works cost to completion, and selling cost of 200. So actually, if you look at this NRV, look at them here side by side. The NRV here is 4.5 less the 1,000 to get to sell it, less the 200 cost to sell it. So it's actually there, the NRV is 3,300. So just be careful, you must include the costs associated with it as well. Cost of completion, in this case repair work, and the cost of selling. So the value on this item in inventory, it shouldn't be included at cost. The cost is overstating what you can realize from it. So it's going to be included at 3,300 in the accounts. That's your answer there. Closing value there for the inventory, 3,300. If they had said that the NRV, for example, was 5,300, then you would have no adjustment. You would leave it at the 4,000. So it's only if the NRV is lower than cost would you adjust. Other than that, you will leave it as it is at cost. That's an important thing the students often get caught out on. You don't always make an adjustment, only if NRV is lower than cost. Another issue that can arise in IAS2 is, well, what happens if I previously wrote down a particular inventory, maybe because the market price had declined, and now I want to reverse that write down because the market prices have increased again and I can sell it for above cost. So an item that had previously been written down and the subsequent selling price has improved, you can reverse it. This is the only time you'll actually write it back up. But the amount of the reversal is limited to the amount of the original write down. So what we mean by that is, if you've written down an inventory to its NRV 2 years ago, and you want to write it back up now, you can only bring it back up to its original cost. You can't bring it back up above that, because otherwise you're defeating the purpose of IAS 2, which is the rule is lower of cost and NRV. So you can write it back, but that's only based on what the original write down was. That's a complicated one you might see in the odd exam question. So take, for example, here. As at the 31st of December 2013, an item of inventory cost 2,450. But economic conditions have deteriorated, you're in a recession, and the selling price is now 1,750 before transport costs of 60. So your new 31st to 12th, 2013, your NRV is 1,750 minus 60, which is 1,690. All right, your cost is 2,450, so that means you have a write down as cost is bigger than NRV. You have overstated the inventory in the accounts because it's in there at 2,450, whereas you can only get 1,690 from it. So that means you have a write down here of 2,450 minus 1,690. The inventory is overstated by 760. So your inventory is overstated by 760. It's in a 2,450, should only be in a 1,690. So how you do that is you debit cost of sales, 760, you credit closing inventory, 760. So think what I'm doing there. I'm saying my closing inventory is overstated. So to reduce an asset, I credit the asset. Credit closing inventory. I'm also saying that, well, if closing inventory is lower, my cost of sales are going to be higher. So I debit my cost of sales to 760. This is assuming, as we're told already, the 245 is already in the statements. So we're adjusting on that basis. Roll on a year later, 31st of December 2014, conditions have improved. The NRV now for the same product, 2970 minus 60, which is 2910. Right? So this is the reversal of a previous write-down. So we're saying the conditions have reversed. Now, what a lot of students incorrectly do is they say, well, that means I'm going to reverse it and compare the 1690 to the 2910 and create a reversal of 1220. That's not correct. The reason it's not correct is you can only reverse it back up to the original cost, which in this case is 2450. So you're going to go 2450 minus 1690, which in this case, if we look at it, is the same as we had before, the 760. So you can only reverse the 760. Right? That's an important one that you understand. You can't go above that. You can't revalue it higher than 2450. That's the original cost. And it's always the lower of cost and NRV. So you'll debit closing inventory here, and you'll credit cost of sales. So you're just reversing the entry. So that is something to watch in exam questions. When you have a reversal of a previous write-down, it is limited to be consistent with that rule, lower of cost and NRV. So it's a tricky one, but you'll see that in the odd exam question where some students get caught out and they just don't think and they reverse the full amount. Whereas in fact, then they've reached that rule, you're valuing it at higher than the original cost to the company. So there's two other small items to watch for. If you have a byproduct that has an insignificant value compared to the main product. So for example, you might have a byproduct of milk production. You might have a byproduct of jam production, whether it's the sugar surplus, etc. The sales proceeds of this can be reduced the cost of inventory. So instead of having to recognize separate revenue from a byproduct, you can actually just credit cost of sales instead of crediting revenue separately. Now that's only when the byproduct is insignificant. If it is a significant amount of material, then it has to be treated as a separate revenue recognition line item. The other small exception, and you won't see this too often, is if the company has raw materials and the NRV of the raw materials is below cost, which means the NRV should be written down, but the company uses this raw material in a final product that is profitable. So I take my cocoa beans that have now been reduced in value, but I can put them into, for example, a coffee product or a chocolate product that is going to be profitable. I don't need to write down my raw material. Now that's a bit of an advanced one. Don't get caught up too much in it, but there are two small little exceptions to watch out for in IAS 2, dealing with byproducts and dealing with raw materials that will subsequently be used in a very profitable finished good or finished product. All right. One small thing that is more for practice, and you'll deal with this in auditing of inventory as well, is inventory count timings. This does come up in a couple of exam questions as well. Sometimes the inventory count may not happen exactly at the year end. And that can happen because of staff shortages, businesses are busy at the year end, and for practical reasons then, the inventory count may happen 2 or 3 days beforehand or 2 or 3 days afterwards. And you can't just use inventory on the 29th of December or inventory on the 3rd of January in the financial statements. It must be the inventory that's there at 31st of December. So we have a procedure what you can use called a rollback if you did the inventory count after the year end and want to bring it back to the year end, or you can do a roll forward procedure where you undertook the inventory count before the year end and want to bring it forward to, for example, a 31st of December year end. And what you need to be able to think about then is, how do I adjust those figures to get the right figure in the statement of financial position and the statement of profit and loss for my closing inventory? And the best way of looking at this is, let's look at an example. Right? The inventory was counted in the 2nd of January 2020. Right? So 2 Jan 2020, 89,000. So that is after the year end. During that period between the year end and the inventory count, there was goods sold, and these sales were included in 2020. So that's fine. They're sales after the year end, but they will have an impact on how to get back to the 31st of December. Also, during that period between the year end and the count, goods were purchased, and they've been included in inventory on the 2nd of January. And what we're asked is, what is the 31st of December 2019 inventory? How to work back. So we have it at the end of the 2nd of January, but we know there has been post year-end sales, and there's also been post year-end purchases. Now you have to be careful because this is slightly different whether you're doing a roll back or a roll forward. In our case here, what we're doing is a roll back. Because we've gone the 2nd of January, we want to roll it back 3 days to the end of December. If we did it on the 26th of December, we'd want to roll forward to the end of December. And how you do that is slightly different. And you'll see that in the question pack associated with IAS 2 questions here. So post year-end sales, these goods were sold for 18,000. Right? Frupo set its price at cost plus 50%. The 18,000 sales were included in the sales records in January. So think about it. These were sold after the year end, but they were in inventory at the year end. So we need to add back cost of these in stock at 31st of December. So that's an important one where students confuse. Well, they were there at the 31st of December. They wouldn't be there when we did the inventory count because we've them sold, but they should be added back because they were there 3 days earlier. And that will be not the 18,000 because the 18,000 is the selling price. Inventory is always measured at cost. So it sets its price at cost plus 50%. You divide by 1.5 because your sales revenue must be 150% of cost. Your markup there is 50%. So you're adding back 12,000. So we're saying the cost of that inventory is 12,000. That would also have been there at the 31st of December. Now that is tricky. The sales are correctly included in the next year, but the inventory, because it was there at the 31st of December, should be included. It wasn't there when you did the stock count, so you need to add it back at its cost. Goods costing 40,000 were delivered on the 2nd of January and have been included in here. So these were in the stock count, but not there at 31st December. So these have to be excluded. They were there, they're included in that 89,000, but actually they only arrived on the 2nd of January. So they were never there at 31st of December. They would have been included at the 40,000. The recommended selling price is there to throw you, that's not included. Inventory is always measured at the lower of cost in NRV. Cost is lower here, they would have been included at the 40. So we take out the 40,000 because they should not be included at the year end. So your closing inventory there is 89 plus 12 minus 40, which is 81. 81,000, and that's what's called a rollback procedure. You're rolling it back from a post year end inventory count, 89 plus 12 minus 40. Sorry, that should be 61. I was thinking that was a bit high. So 12 is left off. They were there at the year end, but they've been sold post year end, and purchases they're taken away because they're included in inventory. They weren't there at the year end, right? So just be careful there now. That would be different if you were doing a roll forward. If you were doing an inventory count before the year end and bring it forward to the year end, you will be adding on sales and you'll be taking away sales and adding on purchases. So the more practice you get with that, the better. But there is a common exam question as part of IAS 2. It's a practical consideration when inventory counts don't happen exactly at the year end. How do you bring it forward or bring it back to get the inventory that was there at the year end? That's something you'll come across in audit as well in your studies. So to have a look at an example of IAS 2, a good one there is Glambia. If we look at page 167, where we look at the financial statements first, you see the statement of the group balance sheet. it gives you a note 20 for inventories. Current assets, about 440 million, 447 million of inventories. When you go to note 20, which is on page 167, you can see as part of the requirement in IAS 2, you must disclose the different components of that 447. How much is raw materials, how much is work in progress, how much is finished goods. Consumables would be, for example, spare parts for a production process. In an office setting, it would be ink, it would be paper, stuff that's going to be consumed as part of the business. The other things you have to disclose as well is how much did you write off of inventory as an expense in cost of goods sold? Was there a write-down of inventory during the year? And was there previous write-downs that were reversed during the year? So you wrote down 26 million because NRV was lower than cost, but for other inventory it actually increased, and you reversed some of that as well, 2.8 million. So see all the disclosures there, right, of what's going on in the question. Now, why I'm a big fan of looking at the model financial statements as well is it's not clear why all of these are disclosed. They don't tell you the standard, they don't mention it. Now, if we go back to the accounting policies here, at the end of the financial statements, they will mention inventory here somewhere. Summary of the key of accounting policies. It's usually mentioned here somewhere. Cash equivalents. Inventories, you can see it here. State at the lower of cost in NRV. They use the FIFO method or the weighted average. So that just tells you what their policy is for inventory. And that's included on page 135. That's a requirement of every company that they show their key accounting policies for each of the main items. Right? And you can see again, cost of finished goods, it covers raw materials, other direct costs, and overheads based on normal capacity. That's what we covered in class this week. We covered FIFO and weighted average. We covered the lower of cost in NRV. So all of the stuff you're learning in class is applicable to real world companies. While I'm a big fan of looking at the model financial statements as well, the reason for that is if you go, for example, here, and you look at the financial statements, say the consolidated statement of financial position, and you come down to current assets, we see inventories as note 26. But the reason I like this is they give you in the margin here all of the particular standards and the particular paragraphs of why that's been disclosed. And if you go to note 26, which we'll jump on, one of it. You see here, raw materials. It tells you the standard IAS 2 paragraph 36. That's why they split raw materials, work in progress, and finished goods, which we've seen in Glanbia as well. Paragraph subsection B. Subsection D tells you you have to disclose how much of an expense you did for cost of inventories in the profit or loss statement. Paragraph E and G tells you must disclose how much of a write-down during the year and previous write-downs that were reversed have to be disclosed as well. So everything that has to be disclosed, that Glanbia have disclosed there, in their note 20, the model financial statements tell you exactly which paragraph in the standard that's coming from. So it's a useful one to get an idea where is that a requirement from. That's why I'm a big fan of looking the model financial statements as well. And remember, you can control an F. So if you're looking all references for IAS 2, you can just control an F and it will find you all the references. That'll be useful for some of the other standards like agriculture, which we're going to cover soon as well. So certainly use some of those model financial statement and all the real ones, Kerry Group, Glanbia, and CRH, just to see in the real world how is IAS 2 accounted for and how is it presented as well. So they're all the kind of disclosures we talked about. They're mandated as part of IAS 2. So it is a key part of any accounting requirement. You must disclose the accounting policies. We've seen those for Glanbia. The carrying amount of each class of inventory. We saw that, raw material, work in progress, finished goods. The amount of inventories recognized as an expense. Carrying amount of inventories carried at fair value less cost to sell. That's quite niche. Don't worry too much about that. Write down of inventories. Reversal of inventories. Explaining the write down and the reversal. and any inventory pledged as securities. You'll see that in the model financial statements if you go back. They said inventories with a certain carrying amount have been pledged as security for the group's bank overdraft. That's a key disclosure requirement as well. So clearly Glanbia don't have any of that because they don't have disclosed that in their note for inventories. So for all of these standard disclosure requirements are a key aspect. In terms of FRS 102, they're very similar. Section 13 of the UK and Irish GAAP, Generally Accepted Accounting Principles, covers inventory. And its Section 13 is very similar to IAS 2. No main differences or huge differences to worry about. So for you, go back and have a look at a chapter, at least one of those chapters. Whichever one is entirely up to you. They're all available in ebook format in the DCU library. Have a look at question pack 8. And in a week or two time, we're going to have a tutorial question on IAS 2 inventories as well. If you want to read a bit more about the standard, you can follow that hyperlink and it gives you the history of the standard and the key summaries of each one as well. So that's a quite useful one if you want to go and practice and just get a bit more information about where IAS 2 came from and the different variations that have been in effect over the years. All right, so that finishes off IAS 2 for week 3. The other key recording you're going to have this week is a shorter standard, and it's going to look at IAS 41, which covers agriculture.